Hello everyone, and how's it going? Welcome back to my channel where we talk about the most interesting titles in the market. In today's world of investment, people often ask themselves where's going to be the next big thing and how to accurately seize the opportunities before they're spotted in the mainstream and how to profit from safe, predictable income streams. To answer the last question, the title Schd, an ETF by Schwab, has been created. It correlates with some of the world's most famous and successful companies and distributes dividends from stocks incorporated within. And to a large extent, the Schwab US Dividend Equity ETF chooses the safest and the most stable industries in our economy to invest for the long term. Now, perhaps another reason why SCHD has attracted so much attention from market participants is its price action since the inception, as well as the dividend track record. Over the past 5 years, despite strong economic headwind, the Schwab ETF managed to increase its share price by almost 50%, which in that regard alone has already beaten many riskier counterparties. If we go back as far as 2011, SCHD increased its price by more than 180% since the beginnings. Before the video continues, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. So, SCHD has been lingering around the $75.25 level lately. It represents around a 0.4% increase compared to like a month ago, and a 2% increase over the past 6 months. It rebounded by 13% from its low on October 27th, maintaining a $67 level. Throughout the entire year of 2023, SCHD has been maintaining a sideways course, finishing just 0.5% higher than the 2023 beginning point. And 2024 appears to be following a very similar trajectory, showing minimal change at all. However, there's a buzz in the air with the anticipation for some substantial movements. We're cautiously optimistic, especially given the recent instability in the stock market. And something that's quite interesting as well is that holding on to SCHD won't break the bank. With an expense ratio of approximately 0.06%, it's like having a very economical ticket to over 100 US stocks. Prominent names like AbbVie, Texas Instruments, and Broadcom are all part of the mix. Essentially, it's an investment in the heart of American economy without the hassle of managing individual stocks. Now, what about dividends? SCHD has the aspect covered as well. In terms of the yields, they offer around 4%, and they've been consistently increasing the amount of dividend distributed over the years. It's like a perpetual gift that keeps on giving. Now, why is SCHD so popular? Because it's a preferred choice amongst both seasoned investors and everyday individuals like you and me. Like, with the expectations of interest rates undergoing their own fluctuations, SCHD might be gearing up for an exciting journey, so stay vigilant as the ETF navigates through those very interesting market conditions and times. With that being said, here's the technicals. The trading volume of Schwab US Dividend Equity, so SCHD, has recently been around 4.3 million shares, compared to the average of 4 million shares. Over the previous 52 weeks period, the price has fluctuated between $66.67 and $78.23. The volume of shares traded tells us how many shares are being bought and sold at any given point. If the float is too thin, it would be easy to push the stock price around but hard to exit the strategy. As we compare the current volume against the average volume, there could be possibility for trend reversal or breakthrough if there's significant difference against the average. The assets under management of Schwab is around $52 billion as far as SCHD is concerned. As we compare the current price to the historical price fluctuations, the stock is 1% higher than the 1-month low, 13% higher than the 3-month low and 13% higher than the 52-week low. On the options market, which often gives us a hint of the market sentiment about where the stock price could go next, the implied volatility is 12%, compared to a historical volatility of 11%. The put-call volume ratio is currently at around 34%. It is normal for many stocks to have a higher put option because their long positions are hedged. The most recent volume of options traded is 2.6 thousand contracts a day versus the 30-day average of 1.7 thousands. Regarding open interest, the most recent volume of open interest is 65,000 contracts versus the 30-day average of 60,000 contracts. Regarding the shareholder structure, institutional shareholders own 40% of the outstanding shares. The biggest shareholders include Charles Schwab, the Bank of America, and Morgan Stanley. It is best to see some institutional presence when holding a stock long-term, as it would offer a layer of stability and reliability. It means that overall the market participants believe that this company will deliver what it promises, which is a very important factor to consider for long-term holding. The current short interest is around 874,000 contracts over the total float, 40% of which from the dark pools. Now, this is much lower than the 15% threshold that we usually give for for institutional short attacks presence, and also for the potentials for short. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins. Higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Typically, I recommend gradually building a position over an extended period of time. The potential decrease in interest rates could instill a renewed sense of confidence in the favorable market trend, attracting additional investments towards stocks for potential returns. However, exercising caution is very essential, given the currently elevated historical market value of SCHD. Despite the likelihood of fluctuations, the ETF has the potential to act as a dependable and reliable stabilizing element in a portfolio oriented for long-term growth. I would recommend to commit around 10 to 15% of your portfolio in SCHD and to split the allocation in batches of 20% at a time over the next 3 to 6 months so that you may purchase more in case of retracements.